Welcome back to the channel, Options Over Ordinary. Today, we're going to go through a comprehensive guide on understanding the option chain screen. Whether you're a beginner or looking to refresh your knowledge, this video will break down everything you need to know, including the crucial Greeks. So let's go ahead and dive right in. Options are financial instruments that give you the right, but not the obligation, to buy or sell an asset at a specified price before a certain date. They're a powerful tool for hedging, speculation, or generating income. You may be asking yourself, what is an option chain? Well, an option chain is a listing of all available option contracts for a particular stock or asset grouped by their expiration dates and stock prices. It's your go-to screen for analyzing and selecting the right options for your strategy. Each financial website and broker will have a slightly different look, but the fundamental information and location should be similar. Here's an option chain from Fidelity. Let's break down the key components of the option chain screen. First is the underlying asset. This is the stock or asset for which the options are being traded. It's usually listed at the top of the screen. In this example, I'm using Labu, which represents Direxion Daily S&P Biotech Bull 3X shares, which means it trades on 3 times the volatility. Remember, option contracts allow the buyer of the contract to have control to buy or sell 100 shares of the underlying asset. 2. Expiration dates. These are the dates on which the option contracts expire. They're typically displayed in a column or a drop-down menu. Most underlying stocks have weekly expirations, but some have only monthly expirations and some ETFs have daily expirations. In this example, there are weekly and monthly expirations available. Third is the strike price, the predetermined price at which you can buy via call or sell via put the underlying asset. Strike prices are listed in the middle of the option chain. For more information on strike prices, check out my recent video popping up on the screen right now. Fourth thing to understand on the screen are calls and puts. The option chain is divided into 2 main sections. You'll see the calls on the left and the puts on the right. Each row in the option chain provides specific data for individual options. Last price is the most recent price at which the option was traded. The bid and ask prices represent the highest price the buyer is willing to pay, which is the bid price, and the lowest price the seller is willing to accept, which is the ask price. This is the cost of the option, or premium paid as a buyer and premium received as a seller. The bid-ask prices are quoted per share. And remember, each contract represents 100 shares. So the actual cost will be the bid-ask times 100. Recall that each option contract has 2 parties, the buyer and the seller. The bid-ask prices can be viewed like a marketplace, where the buyers and sellers haggle over the price of an item for sale. The final price is usually settled in the middle of the bid and ask prices. Another important column is volume. This is the number of option contracts traded during the current session. Higher volume often indicates greater interest and liquidity. Try to avoid contracts with low volume, as your trade may not go through or will be priced at a lower premium than what you would like. Fourth is open interest, the total number of outstanding options contracts. It helps gauge the market's interest in a particular strike price and expiration date. Next up is implied volatility, IV. This is a measure of the market's expectation of the asset's future volatility. Higher IV typically means higher option prices. Now let's move on to the Greeks. The Greeks are mathematical calculations that are essential for understanding the risk and potential reward in options trading. Let's break them down. First up, and my favorite, is delta. Delta measures the sensitivity of an options price to a dollar change in the price of the underlying asset. A delta of 0.5 means the option price will change by 50 cents for every $1 movement in stock. There is also a very strong correlation between the delta and the chances of a particular options contract expiring in the buyer's favor. For instance, a delta of 0.2 means there's approximately a 20% chance of the buyer making money in the contract. The seller would have an approximate 80% chance that the contract is not exercised and would close out worthless. Next up is gamma. Gamma represents the rate of change of delta for a dollar change in the price of the underlying asset. Gamma is a rate of change in the options delta that shows how sensitive option prices are to underlying asset movements. Higher gamma indicates greater sensitivity and potential for quick changes in delta. For calls, the call option becomes more sensitive when the stock price increases, indicating a greater possibility of the option being in the money. For puts, gamma indicates that when the stock price decreases, the put option becomes more sensitive, indicating a higher likelihood of the option being in the money. Next is theta. Theta measures the rate of decline in the value of an option due to the passage of time. A theta of negative 0.05 means the option loses 5 cents in value each day. Now we have vega. Vega indicates how much an option's price changes with a 1% change in implied volatility. A vega of 0.10 means the option price will increase by 10 cents if volatility rises by 1%. And finally, we have rho. Rho measures the sensitivity of an option's price to changes in interest rates. A rho of 0.05 indicates the option price will increase by 5 cents if interest rates rise by 1%. There's a lot of information about the Greeks. However, in my personal trading, I largely focus on delta. To effectively analyze an option chain using the Greeks, consider these steps. 1. Identify the trend. Look at the underlying asset's trend and decide if you're bullish, bearish, or neutral. 2. Select your expiration date. Choose an expiration date that aligns with your trading strategy. Short-term options are more volatile, while long-term options are more stable. 3. Choose your strike price. For calls, select a strike price above the current asset price if you're bullish. For puts, choose a strike price below the current price if you're bearish. 4. Analyze liquidity. Opt for options with higher volume and open interest for easier entry and exit. Remember, higher volume indicates better liquidity. And 5. Consider the Greeks. Use delta to understand the directional exposure. Use gamma to gauge potential changes in delta. Use theta to assess time decay impact, vega to evaluate the effect of volatility changes, and finally rho to consider interest rate influences. Understanding the option chain screen and the Greeks is crucial for any options trader. By familiarizing yourself with its components and practicing analysis, you'll be well on your way to making informed trading decisions. For my trading, I mostly focus on delta, but each Greek has its benefits to fine-tune your trading. Here are some practical tips to enhance your options trading. 1. Start small. Begin with a small number of contracts to manage risk and get comfortable. 2. Use spreads. Combining options like vertical spreads can limit risk and maximize potential profits. 3. Monitor the market news. Stay updated on market news and events that can impact volatility and options prices. 4. Paper trade. Practice with a demo account, which most brokerages offer. This allows you to practice with fake money before you commit real money to build confidence and refine your strategies. And finally, regularly review the Greeks. Adjust your positions based on changes in the Greeks to maintain your desired risk profile. I hope you learned a lot of great information in today's video on the option chain. Thanks for watching. Don't forget to like, share, and subscribe for more trading tips and strategies. Happy trading! Friendly reminder, the information provided in this video is for informational purposes only and does not constitute financial, investment, or other professional advice. I am not a licensed investment advisor, and the content should not be constructed as investment advice or as a recommendation to buy, sell, or hold any securities or financial instruments. Always consult with a qualified financial advisor or conduct your own research before making any investment decisions.